Right, let's get started, shall we? Hello, thank you for being in today's session. Hopefully, we're all coming through loud and clear. Today, we're going to be talking about the essentials for successful trading. So, if you're brand new to trading, this is going to be a great session for you. If maybe you've been trading for a little while, but perhaps you want to go back to basics a touch, that's absolutely fine as well. And we're going to be going through some of the things that really traders need to know before they start to place their first trades. So I'll probably be going on for, I don't know, half an hour, 40 minutes, something like that. This is live, this is interactive. I'm on GoToWebinar right now, and I'm also casting to our YouTube, Facebook, LinkedIn, and my own Twitter accounts as well. So if you're seeing it on there, that's great. In terms of interaction and asking questions, do ask those questions through. I'll be able to answer the questions live on GoToWebinar straight away. So fire those through into that questions box. So if you have questions, this is what you've got to do. If you're on the GoToWebinar app, this is from the smartphone, tablet, that sort of thing. You see the question mark at the bottom there. Just hit that and then start typing in. Now, if you are on a downloaded sort of a computer, if you like, so a laptop or desktop computer, it might look something like this. It might look a little bit different. Either way, on the right-hand side, it might be that you've got a question mark, a question bubble on the right-hand side. Hit that, and then it brings open the chat box. Or if you've got the GoToWebinar program, you may see this very small little panel floating around. Hit the orange button. You can then type into that bit there. So if I get everybody just typing something in, that'd be fantastic, just so I know it all coming through loud and clear, and then you can ask questions as we go through. Okay. So what are we talking about today? Well, we're going to be talking about a number of things in terms of, as I said, this is the basics, right? This is what we need to know before we start making our trading decisions. And one of those is, what are the different markets to trade? We're going to talk about what pips are versus what points are, and how we measure that and why it's important. We're going to look at leverage, so what that means to us. We're going to look at the ability to go long and short today. We're going to look at tax implications as well. That sounds boring, doesn't it? But we're going to look at the idea of the sort of the tax-free status, if you like, of spread betting under current legislation. We'll look at the different types of account that we might have, whether you want to trade traditional shares, whether you want to trade spread bets, CFDs. We can look at those. Trade examples, and also what that means associated with things like leverage, things like pips points, and so on. And that's what we're going to be doing today. All right, we'll look at a couple of the bits as well. We can talk about the most important economic data announcements as well, and so on. So let's get going. So the first thing is really about markets that we might want to trade. Now, when it comes to, again, I'm going to focus more on the spread bet CFD side of things, which is really what we do here. In terms of markets that we can trade, one of the more popular ones is Forex, foreign exchange, and you'll be familiar with pound against the US dollar, euro against US dollar, and so on. And a broker platform might list that in terms of majors, minors, exotics that you might see on the platforms. Me personally, and what we recommend our traders to trade is really a cross between one of, two of 8 currencies, basically. So what would those currencies be? Pound, dollar, euro, the yen, the Swiss franc, New Zealand dollar, Australian dollar, and there's one more, the Canadian dollar. There you go, there's the 8 currency pairs. And what we generally do is we trade crosses of those. So in other words, one of those 8 currencies against another one of those 8 currencies. Those tend to be the more liquid markets, and liquidity basically means the amount of trading volume that's behind it. So that typically means lower spreads as well. What we don't tend to get too involved in is things like the Mexican peso or the zloty or the rand or something like that. And the reason for that is a lot of it is the way in which it moves can be a lot more erratic, and also the spreads, the dealing costs associated could be a lot higher as well. So it tends to be a little bit more specialist, I would say. What I've got on here is the leverage side of things. Now, what I'm not going to do today, by the way, is give you a history of Forex. Nobody's really that interested in that, I don't think, and we don't really need to know it. It's good for the search engine rankings, but it doesn't help us to make money, really. From a leverage perspective, this is when we talk about what our buying power is. Typically, if you're trading within the European Union or the UK, then you've got about a 30 to 1 leverage on that. That means for every pound on your account, you could buy £30 worth of a particular currency. So effectively, you are using your money in a particular way. Now, leverage, we're going to come into that in a second. It's a little bit like looking at it on a 3.3% deposit basis. I'm going to give you some examples of that in a second, and we'll come back to it. Indices, this is stock market index like the FTSE 100, which is effectively an algorithm based on the sort of is determined by the movement of the stocks that are within that index. So the FTSE 100 as an instrument that we can trade moves based on the movement of the 100 stocks within the FTSE 100. The Dow is based on the movement of the 30 stocks that are within the Dow, the S&P 500 from the stocks that are within the S&P 500 and so on. And it creates an instrument that we can then trade, which basically is the broader index. It's slightly low risk way of trading and so on. Hence the margin requirements being slightly better than individual stocks on their own. Typically, we can trade this at 20 to 1. So in other words, that means we need a 5% deposit. Again, I'm going to explain what that means later on. Seems like a bit of a typo. Oh no, there isn't. So commodities, that can vary from 10 to 1 to 20 to 1, depending on the type of commodity you're trading. Typically, there could be trading about the future price movement of gold, silver, oil, wheat, and various other things as well. And then we could trade individual stocks, also typically trading at 5 to 1. That means a 20% margin requirement, and that gives the opportunity to trade things like BP shares, Apple shares, Amazon, whatever else it may be. Now, in terms of margin, what on earth does that all mean? These percentages here, effectively, now your broker percentage might vary a little bit, but effectively this tells us what percentage of the notional value do we need on our account in order to open that trade. Now, that all sounds kind of scary, kind of confusing maybe, but actually we're used to margin requirements and we're used to leverage in our day-to-day lives. If you think about a house and you think about the deposit and you think about the mortgage, okay? Hard to write with a mouse, but anyway, if you think about if you're going to buy a house, let's say it's a 100k house, we wish. Deposit, let's say that the minimum deposit that the bank would allow you to have, or cash that you have to put into it, will be 10%. Okay, that's relatively normal, 5-10%, something like that, which means that the mortgage would be for 90%. Okay, that's basically, it's a similar experience when it comes to trading. So what does that effectively mean? If you're going to buy a 100k house, you need 10% down as cash. That's effectively 10k. Okay, and then the mortgage will be for the rest. What this basically means is that if that house went up in value to 110k in terms of price movement, it's gone up 10%. In terms of return on capital, you put 10% down, which was 10,000. It's moved up by 10,000. That means the return on capital will be up 100%. Okay, so it's the potential of using that capital in order to get better returns. Okay, and hopefully that makes sense. So hopefully that's okay. So and equally, if the house price fell in value to 90,000, effectively that will be a fall of 10%, which would mean that that's your £10,000 effectively gone. So all of that capital will be gone as well. So it's a double-edged sword, and it's the same thing with a house. You know, house prices can go up in value, house prices can go down in value. The same thing that they can with shares, with forex, with commodities, indices. We can get it the right direction, we can get it the wrong direction. And the margin requirements, the percentages I've got over here, effectively tell us what our broker requires of us, or indeed what the regulator requires of us in order for us to open the position, which would be the equivalent of our house deposit. And then what we do is we then have a financing arrangement, a funding arrangement, much like a mortgage, with the broker to allow us to hold positions overnight. Okay, if you're a day trader, you don't have a funding charge. If you're in and out of the trade within the same day, there's no funding charge for holding that position or the borrowing available because it's an overnight thing. If you hold positions for overnight for 1 day, 3 days, 5 days, 50 days, whatever, there will be a cost associated with that. All right, hopefully that's all making sense. The thing about it is, in my experience, leverage or margins, are not something to be scared of. What they are opportunities. They're something that allows us to use our capital more effectively, as long as we understand how we need to be using it. Okay. So that gives you a bit of an understanding, and we'll go through some examples a little bit later on, and practical examples, looking at some deal tickets, etc. So what we have here is a slide which talks about how we could perhaps compare the type of execution that we'd get, whether it's with a share dealing account, CFDs, or spread bets. So when it comes to trading across these different types of accounts, if you're going to trade shares with a stockbroker, typically your margin requirement would be the full value because you're taking ownership of the share. So you'd need to put down 100% of the value of the shares that you wanted to buy plus dealing costs. So if you wanted to buy £10,000 worth of Vodafone shares as an example, you would need £10,000 on your account in order to do it. There is no leverage available. You're buying it in full, just like buying a house for cash without the need for a mortgage. Same thing really with CFDs and spread bets. They're very similar. People often ask, what's the difference between CFDs and spread bets? There are a couple of differences, but in reality, it's really packaging. They are, for all intents and purposes, they are basically the same. So there are differences, in terms of different currency accounts, in terms of what you're staking to and so on, but they're broadly the same, and the leverage is broadly the same as well. Okay, so and you can see in here the type of leverage and so on that one might be able to get. Just trading shares alone is advantageous as a CFD or a spread bet because it means you can trade 5 times your money. So effectively, if you had £1,000 on your account, you could trade £5,000 worth of shares. Now, it's important to reference here 2 things really. Number one is that whilst I'm making comparisons against housing will not change in value anything like to the speed at which these markets will. So that makes them a riskier asset class or type of trading. Okay, that's important to note. And the other point is that just because you can trade stocks at 5 to 1 or at Forex at 30 to 1 doesn't necessarily mean you should. With £1,000 on your account, like I said, I can buy £5,000 worth of a stock, but that doesn't mean that I have to. I could still buy £1,000 if I wanted to. I could buy £500 worth. I could buy £2,000 worth. The point is that I have flexibility with it. What actually might be a better thing to do, instead of loading it all up into one stock, what I might decide to do is trade multiple stocks to actually diversify a little bit. I can still load up on my opportunity and my potential with this, but I could diversify in some way. So actually with my £1,000, instead of buying £5,000 in one stock like Vodafone, what I could do instead is buy 5 stocks. I could buy £1,000 worth, which would be £200 of capital, in Vodafone. I could buy another £1,000 worth of BP. I could buy another £1,000 worth of Rio Tinto. I could buy another £1,000 worth of Apple, whatever. You can spread and diversify your risk accordingly. So just because you have the opportunity doesn't mean you have to go all in poker terms and all guns blazing. Okay. Other things we need to think about is that if you want to trade with a stockbroker, typically they're only going to let you go long. What does long mean? We're going to talk about that later. It basically means, though, that you can only make money on rising prices, notwithstanding dividends. But effectively, if prices go up, then you have the opportunity to make money. If prices go down, you'll be losing money. Okay, that's really the simple part of it. Spread betting and CFDs, on the other hand, you can make money on falling prices as well by going short, so long as when you buy the stock first and then you look to sell it later on. Short is when you sell the position first and look to buy it back at lower prices later. How does that happen? It's just direction. It's just direction change. If we think the market's going to go up, we can make money on rising prices. If we think the market's going to go down, we can make money on falling prices. Don't worry too much about the mechanics of what's behind that. Why is shorting therefore, why is it a good thing? It's a good thing if used the right way, much like buying is a good thing if used the right way. So what do we need to be thinking about here? Well, when you think about bear markets, you need to think about the fact that the Nasdaq was down 33% last year. So if the Nasdaq's down 33%, the incumbents, the stocks within the Nasdaq are going to be getting, hit pretty hard as well. So what does that mean? It means that actually the ability to make money on falling prices gives us additional opportunities to make money. It gives us more flexibility. And actually, I would say as a trader, we can't rely and shouldn't be relying on stock markets rising in value as the only opportunity for us to make money. Why? Because they don't always go up in value. And that could be on a year basis, certainly on a week by week basis as well. We need that sort of flexibility. Spread betting CFDs offer that. From a tax perspective, trading with your share dealing account, your stockbroker, if you're trading, in the UK, which is where I am, profits will be liable to capital gains tax. If you're not too, this is not a tax webinar, so I'm not going to talk about that too much. But profits on tax, that's not particularly fun. But you also pay stamp duty. Okay, so stamp duty on UK stocks. You don't pay it on other markets, by the way, but on UK stocks, you'd pay 0.5%. May not sound like a lot, but costs add up. And I'm going to give you some examples of costs in a second. Trading as a CFD, trading UK stocks, then it is liable to capital gains tax, which can be advantageous, by the way, if you're hedging a stock portfolio, but otherwise it is a potential cost you might want to do without. Of course, I could say that if you're paying capital gains tax from your CFD account, it means that's because you're paying it on your profits, which means you're making money, which means it's a nice problem to have. But then I think many of us will prefer not to pay the tax in the first place, in which case a spread betting account can be more advantageous, which under current UK legislation is tax-free. So there'd be no stamp duty and there would be no capital gains tax in that regard. Typically, spread betting is a UK thing. CFDs can be very global, and obviously share dealing can be very global as well. I just want to give just a second to think about the costs perspective, actually, because I do think this is relatively important. When you think about a share dealing account, if you wanted to buy, let's say, a notional value, let's keep it in shares. A lot of people are familiar with shares. The smaller your account size, smaller your trade size, the more expensive share dealing can be compared to the likes of CFDs and spread bets. And also, it depends on how long you're holding a position for as well. Let's think about commission terms as an example. Let's say your broker will charge you £10 per deal. That'll be £10 to open the trade, £10 to exit the trade. So it'll be £10 and £10. Now let's think about that in percentage terms. £10 as a percentage of £1,000 is 1%. That's in, and then 1% to close the trade out as well. Okay. Now what you'll also get is the stamp duty, okay, which will be 0.5%. Okay, that's when you buy the trade. Now, if you do more than 10 grand, you get charged £1 for the PTM levy, but let's not worry about that. Effectively, that means that your costs for that example would be 2.5% for the trade. What that means is if you can do a share deal of £1,000 worth of shares and you'd have been charged £10 in, £10 out, the stock needs to move 2.5% in your favor just to cover your dealing costs. That's quite a big lump, particularly if you're trading over a short duration. And so, what does that mean for CFDs and spread bets? Well, a CFD broker might also charge you a minimum commission charge. So that can be similarly expensive, although you won't have the stamp duty fee. But doing it as a spread bet can be quite advantageous. And let's explain how. So doing it at £1,000 worth there, typically a spread betting broker, typically what they would need to charge is a bit of spread. They're not allowed to charge a commission. They can't charge you, for example, a £10 commission fee. Why? Because that would then make it a financial transaction and then it would then cease to be a spread bet. So therefore, what they do is widen out the buy price. So your buy price just comes a little bit higher. So instead of buying a share at, 1,000 pence, maybe the price is 1,001 pence. What does that equate to? Well, that equates to a 0.1% markup on the price. Okay, that's the equivalent of 0.1%. So you could be charged that on the way in, and you could be charged that on the way out. So effectively, you're being charged 0.1% in and 0.1% out, no stamp duty, which effectively means the cost of the equivalent trade in and out commission-wise is the equivalent of 0.2% versus 2.5%. That's quite a big difference. And of course, I think we'd all prefer, from a dealing cost perspective, like trading strategy is harder for us to be in control of the outcome. Dealing costs, we can be very much in control of the outcome because we know that ahead of time. We know what we're going to be charged, so therefore we can act accordingly. I would much rather, if all other things are equal, in terms of how much money I'd make or lose, then obvious, in terms of profit and loss on the trade, then costs are something I can control, and that can give us a major advantage. So if you think about that that £1,000 deal, effectively that's a £25 charge versus the equivalent of a £2 charge. That's quite a lot. That's £23 difference. So let's say you did 10 trades in a month. That's £230 difference in this example. I think I'd rather the 230 quid in my back pocket. Thank you very much. Okay, so it can be very, very cost effective. Now, it's important to note that the cost of carry, or when you hold the position over, because of the leverage involved, much like your mortgage, with the cost of carrying each day that you own the house, you're paying money to the bank and so on. There is a similar situation here, but really, what are you going to be charged there? Maybe sort of 6% a year, something like that. £1,000 deal value at 6% a year. Effectively, that means you need to hold it a month just to cover the stamp duty costs. So if you're looking at that, so that's 0.5% a month is broadly what it's going to cost you in terms of value. So if you're in a position for a couple of weeks, it's going to cost you 0.25%. It's not a lot, but it's something you need to consider, of course. And again, it lends itself towards the more short-term nature of CFDs and spread bets anyway. Okay, is this all making sense so far? I know that for some of you who might be a bit more experienced, this might be covering old ground, but at the end of the day, everybody has to start somewhere, right? And even if you've been trading for a while and got some experience, doesn't mean it's all of the experience one needs. And so it's always good to cover off on this stuff. Yeah, we all okay so far? Give us a quick yes or no. Let me know in that questions box, please, everybody. Thank you. Okay, so I think at this point, it's probably a good idea to, I'm not sure what's happened there, to have a look at an example of this. Okay, so if we want to trade pound against the US dollar, now the pound against the US dollar, which in terms of pips and points, will trade to the 4th decimal place. Okay, so that means, what is a pip move? I think we've lost some text here, but effectively, if it moves from 139.78 to 139.79, so that would be a 1 point or 1 pip move. And if we traded £1 per point, every movement of this decimal point here would effectively mean a making or losing of £1. Okay, should be fairly straightforward. Now, what many modern brokers will do is that they will try and make it a bit clearer as to what you're staking to, because if you get the decimal point in the wrong place effectively, or the pip value in the wrong place, it means your notional value will be too big. It means you'll be making a lot more or a lot less profit than you might think. And you can bet your bottom dollar, if you make a mistake and you trade too big a size, it's going to be a losing trade, right? So you lose more than you thought. And you can also bet your bottom dollar that if you make a mistake and it's a loss-making trade, it's a winning trade, you'll have traded a tenth of the size that you meant to. So what does it basically mean? A lot of brokers will slightly increase the font on their deal tickets to make it a bit clearer as to what you're staking to. Forex is typically to the 4th decimal place. I'm going to give you a slide in a second, which is the usual, and you can take a screenshot of that. Now, the spread, this is the difference between these two prices, is 0.9 pips. What is that? That's effectively your dealing cost, like I showed with you before. So that's how much the market needs to move in your favor before you're effectively break even on that trade. In this case, that's a 0.9 pip move. Okay, so if you're trading £1 a point, effectively your implied cost for doing that trade is 90p. All right, so again, it's not a lot, but it's all relative, right? The notional value is the value of the trade that you're looking to do. So what you do is you take the pips that is, the price, if you like, and you multiply it by the trade size what you are looking to do. So if you're going to do a pound a point on pound against the US dollar, you can see the price there, 139.79.2, because that's the pip there. So anything after that is a decimal of a pip. So 13979.2 times by a pound per point gives you the notional value. So if you did a pound per point with that broker, then effectively that's what it would cost you, about just shy of £14,000. That would be the value of the trade. So what you'd be doing there at a pound a point, you'd be buying £13,979 worth of pound against the US dollar. Okay. Now, in terms of the margin required, or the capital you need on your account to do that, remember Forex trades at 30 to 1, right? So we just simply take the value, remember, like our house price, the value of a house, 100 grand or whatever it was, divided by the 30 here, the margin requirement, the ratio, divided by 30. So 13979.2 divided by 30 means that we would need £465 on our account in order to place this trade. Okay, again, everybody, does this still make sense? That is your effectively the equivalent of that's your house deposit. So in order to buy a house of £13,979, you need a deposit you need to put down of £465, and then you'd be borrowing the capital up to that value. Okay, but you'd only pay the funding on that borrowing if you hold that position overnight. Okay. You can take a quick screenshot. I'm not going to go reading out all of this, but a couple of little things to think about here. One is that the brokers can be different. So every broker can have a different unit measurement. Okay, so please be careful with this. Please check your broker. That's the sort of the biggest point I can put on here. But most currency pairs, or what we talk about here, that across of those 8 currencies, will trade to the 4th decimal place. If you've got the JPY in it, the yen, it's typically to the 2nd decimal place. As I said, some brokers will quote you a fraction of a point and so on, but that's your broad rule. And then you've got other rules in here as well. So what is, again, I don't know why it's gone a bit out of line here. And then shares as well. You can it's typically to the penny or to the cent. Okay. So again, take a photo of this if you want to. I'll give you a couple of moments to do that. But again, what you'll normally find with a broker is that they will have like an information button. You can click on that just to make sure it is where you think it is. But this is kind of like your standard pricing that many brokers will quote to. Please fire any questions in, everybody, by the way. So if you're not sure about something, pop a question into that questions box. So let's go through another example. This is an example for dollar yen. So we can see the buy price here. If we think the market's going to rise, then we hit the buy price. If we think we want to sell, we're going to hit think the price is going to go down. We hit the sell price. Okay. So what we're seeing is that this price on US dollar JPY, dollar yen, is traded at 108.41 to 108.42, broadly speaking. The spread is 0.8 points. What does that mean? So the difference between these two prices is 0.8 pips, which means that's effectively your dealing cost. Now, what are we staking to? Well, this is a currency pair with JPY in it, which basically normally means that you're trading it to the 0.01. So a movement from 42 to 43 to 44 would effectively be 1 pip. So if we traded that at £1 per point, for every movement from 42 to 43 to 44, we would make or lose £1, depending on the direction that we are trading. And again, you will see that the font on the deal ticket here is slightly bigger. And again, that's fairly consistent with a lot of modern broker platforms to make it clearer what we're staking towards. Notional value wise, let's just get rid of this decimal point, okay? And let's stick it in after. So if you want to work out your notional value, you need to get rid of the pips, okay? Get rid of the decimal point there and stick it after the large font bit, okay? So wherever that is, that's your cutoff, okay? So there. So 108.42. That is effectively the number of pips that are in this price that you then need to multiply it by your stake. So if you wanted to do a pound a point, it would be 10,842.0, yeah, times by 1, which means it's a £10,842 position. The notional value is that. Now, if you're going to trade that as a CFD or a spread bet and you're offered 30 to 1 on that, divide that number by 30 and that will tell you the amount of capital that is required in order to place a trade. So at £1 a point, it's roughly £362. If you want to do £10 a point, it'll be a £108,000 position. That's fine. Don't get too frightened by that. Forex doesn't move that much in percentage terms, and the requirement will be £3,620. So all other things being equal, basically, it's just an adjustment based on the size of the trades you want to do. Okay, so hopefully we're all still good with all of this. Some basic examples really, but I think they're kind of important. This is an index, the FTSE 100, and similarly you can see here that we have a market that is trading at, if you wanted to sell it and to speculate on prices falling, or short it, 69.31 is the price at which you would sell, and then if you went to close it, you'd be closing it out on the buying price. Okay, 69.33 is the price at which you would buy. So what does that mean? Well, if I wanted to do this at £5 per point, effectively, and I wanted to buy this at £5 per point, well, then I'll be paying 69.33 times by 5. Okay, so there's your cutoff. Okay, so anything after the pips, this trades to the full point. So 69.33, you can see that from the increased font and so on, and you can check the information on your broker anyway. Effectively, what this means is 69.33 times by £5 per point, so £34,665 position. Indices trade at 20 to 1, which is a 5% margin requirement. So 34665 divided by 20, £1,733 required. Simple. Okay. Again, if you want to take any screenshots, just take photos with your phone. That's fine. Okie dokie. Let's move on. We're going to do more examples here. A couple of things I want to cover off on. So now we've got a little bit about deal tickets. There's a few things we're else going to go through. Candlesticks. Some people don't know what a candlestick is. Again, I think this is a bit of a basic if you're going to be looking at charts. What a candlestick demonstrates is that price movement over a particular period of time. That period of time is determined by the time frame that you are using. So that could be a daily chart, a 4-hour chart, a 15-minute chart. What a candlestick represents is the amount of movement over that particular time. So if you're trading on a daily chart, it looks at the price movement for that day or that 24-hour period and demonstrates how prices have moved. What this basically works is like this. So if you're looking at a green candlestick, what this basically means is that the price of that day, if it's a daily chart, closed higher than where it opened. That's basically all that it means. A green candlestick means that the price of that trading day closed higher than where it opened. So that means if you think of the fat part of the candle, this is where the day started, the first trading price for that day. The price then finished the day here at the top of the fat part of the candlestick. Okay. These spikes refer to the highs and the lows. So effectively, you could argue that the price probably moved something like this on the day. Started here, went down to the bottom of the low shadow, the wick, some people call it. The price then rose. I'm making some assumptions here, by the way. Up to the high, the top of the shadow, and down to the close, and it finished the day there. The day would have been something like that. It might have been slightly more erratic. It might have done it a couple of times, and so on. But broadly speaking, that's about what it did. Okay. Similarly, a red candlestick. This means that the price closed lower than where it opened. Okay, so it's a falling price for that particular day. So it opened at this price, closed at this price. This was the high, this was the low. What does this mean in similar terms to what I looked at before? It probably did something like this. It probably went up from that open. Thought, oh no, sellers then drove prices lower, went overshot again, rallied a little bit, and then finish the day here. Okay, so that gives you an idea. The reason why candlesticks are a useful way of looking at charts is because by understanding what the day has done, and some people prefer open, high, low, close bars, is you can get an idea about who's in control. So when you look at it in this basis, it actually tells you that the sellers are more in control because the buyers tried to rise prices, but they that couldn't really control it. Sellers drove prices down, and really that was the dominant move for the day. Yes, buyers lifted it back up a little bit, but not that meaningfully. Okay, so you can get an idea about any support and resistance that's been found by looking at those candlesticks there. Okay, again, I'm not going to spend too long on this one because this is just about covering some of those basics. If we're looking for a particular trading opportunity, then it depends on which direction we want to go. So a long trade is when we want to buy the market looking for prices to rise. And in looking for prices to rise, we're looking to make money from rising prices. So if we think that a particular stock or currency pair, an index, a commodity, whatever, is more likely to rise in the future than it is to go down, we might decide to do a long trade or a buy. In which case we're going to hit the buy button first on our CFD or spread bet platform. Okay. What that means is that we can then sell that trade at a later point. So if we bought something, we then have to then sell it later on. So that means that we'd then be hitting the left-hand price on the deal ticket. So we buy on the buy price, the right-hand side, the ask as it might be called, and then when it comes to sell, we'll be selling on the left-hand price. This is why the spread is important, because that's your effectively your dealing cost. The difference between the buy and the sell price is your cost. Okay, so when we place a particular trade, that there are certain things that we can then do with it. Important to know, this is a simple candlestick chart here, but let's say we wanted to buy at this market here, like this basic sniper strategy chart here. That's where we'd be looking to buy. That's our long entry, our buy, where we'd hit the price, the buy price, in order to look to make money on rising prices. Simple. Now, what we can then do with a deal tick is we can look to capture that profit in a couple of different ways. Number one is we can use something called a target or a limit order. So because we're not going to be staring at our screens all day, or there might be a particular resistance level that we might think, oh, prices might struggle to get through that level, or maybe we want to set an order so that when we go to sleep, if prices get up to where we think it's going to get to, the broker can close it out for us. And that's good because we don't have to sit there staring at the chart all day or all night. So what we can do is we set a target or a limit order is the terminology. A limit is basically, in this case, so we went long, we bought it to enter, so we're now looking to sell. The lowest price at which I'm prepared to sell at, the low limit at which I'm prepared to sell at is X, whatever that price happens to be. You can set that order with your broker platform. And that will be a price that is higher than the current market price, okay? What you could also do is you can set a stop loss order. So whilst you want to here protect your potential profit, whilst you're not at your screen, you also want to have something in there that can protect your loss. So if prices go the other way, which we're going to have loss-making trades, any trader will, we have to accept that. So you can put a stop loss order in. So what this basically is, at a level at which, if the price goes down against us, then again, whilst I'm asleep or whatever else I'm doing, walking the dog or anything, if the price goes down to the level of my choosing, whatever price I happen to do, the broker can then look to close you out of the trade. So as soon as the market trades at our price, what's called a market order will then be triggered to then look to close me out at the first available price from there. So this is called a stop loss order, and it is designed to help us to protect our capital. And again, this will be because we did a buy first, so we own, in inverted commas, this position. We would then look to sell it in order to close that trade off. So we buy to speculate on rising prices, and then, or first we go long, we buy first, and then we hit the sell button to close that trade off. Okay. Similarly, on a short side, and this is important as well for new traders to understand this, that we can make money on falling prices. If you have an expectation that prices will fall, let's say you're worried about a recession, let's say you're worried about bad corporate results from a particular company, you're worried about interest rates suddenly coming in with a shock cut of interest rates, and you're worried about currencies or something. The idea of being able to go long is fine, but in certain scenarios where you think the market is more likely to fall, it's good to be able to make money on those falling prices. In addition, if you have your own stock portfolio, you can effectively hedge in this way as well. So if you were long BP in your ISA or something, you could actually trade a CFD or a spread bet and go shorts to protect that position if you wanted to. You probably wouldn't do it in an ISA, to be fair, because anyway, we digress. We're getting into a weird tangent there. I'm leading myself on. The point with this is that markets will fall and you have the ability to make profits from falling prices. Now, in the first example, when we went long, we hit the buy button first. Let's flip it the other way. If we're going to go short, we're going to hit the sell button first. Now, my God, how can you sell something you don't own? I can get into the detail of that another time. All you need to concern ourselves with at this point is that you can. You hit the sell button with a view to then buying it back in a future date and time or whatever. So the point is you hit the sell button on the deal ticket first, and you're looking to then, well, if you hit the sell button first, what do you have to do to close that trade off? Do you sell it? This is something, the terminology can get a bit weird. Well, I want to sell my short. Well, you can't do that because you're already short. You've already hit the sell button. You'll be buying back your short. So in order to close your sell trade, your short trade, you will have to hit the buy button to then close it off. Okay. So the price, you'd then be filled at whatever the price happens to be on the ask price or the offered price, as it's called. What this means is that we can cover those trades though, and we can set orders, much like we did on the long trades, we can set orders on the short trades in order to protect our position too. So we can put a stop loss above the price. This is effectively saying if price starts to go the other way, I need to have something to cover my risk and to buy this position to close it out and take a loss for me. It's fine. Again, it's normal and so on. But we also want something, if the price goes down there, I want to put in a buy order to close it out. The most I'm prepared to pay is price at X. That's where I want that limit order to be. But that is an order, a buy order to close. I don't want to buy it all the way up here because that's paying too much for it. I think the price is going to go lower first. So therefore, that's where my order is going to be. The limit, the most I'm prepared to pay is X. And therefore, you can set that level with your broker platform, which would be lower than the current market price. All right. Is this all making sense, everybody? Are you all still with me? Give us a quick yes or a no, just so I know that no one's bored to tears just yet. Okay. Couple of examples. We can go through this relatively quickly here. If I wanted to buy pound against the US dollar, £3 a point, and I wanted to do it at 13970.4. Remember, that would be the buy price that we're doing it here. Let's quickly work out the notional value of that. 3 times by the price. Remember, I've adjusted it to put the decimal point after where the font is increased. Effectively, that tells us the notional value. £3 per point times by the price gives me my notional value. The margin required on that is going to be that divided by 30. Okay, to give us that margin rate, which effectively means that I needed that on my account in order to open the trade. Now, the price has now risen and it's gone up to 13990. So now I'm quoted my sell price, the left-hand price, the price at which I want to get out at, is at 13990 to 13990.9. That's a 0.9 point spread. I want to close that trade, in which case I'm going to hit the lower of those two prices. I'm going to sell at 13990. And that means I bought at 13970.4. I'm going to close at 13990. That is a profit of 19.6 points. Great, lovely. I did that at £3 per point. So 19.6 times by 3 is £58.80. And that's it. That's why spread betting is quite attractive, because actually in mathematical terms, it's quite simply packaged, basically. Now, in terms of return on capital, what does that mean to us? Well, if we needed £1,397 on our account to do this trade, £58.8 as a percentage of the margin required means a 4.2% return on capital. Pretty nice, thank you very much. Okay, that's the advantage really of trading spread bets and CFDs. Okie smoky. Hopefully that was okay. So look, that's going to be pretty much it for me. It's sort of fast and furious, but hopefully that was all making good sense and good value. I appreciate some of you that are more experienced. This may not have been in the right session for you, but that's okay, right? Sometimes it's good to go back to basics. But the whole purpose of these is to give different content each Tuesday, depending on where you're at with your trading. So sometimes in these Tuesday screen shares, we'll talk about strategy. Sometimes it's more about the fundamentals and the basics that we go through as well. Sometimes it's live trading, we'll see where it goes. So just keep an eye out for those. If you want to learn a little bit more about trading strategy, why don't you tune in to one of our live sniper strategy trading workshops. This is where we teach the sniper strategy and we go through a little bit more about what it is. So the specific strategies that we employ at Trend Signal that can help us to trade with confidence as well. So if that's something you'd be interested in, then do by all means go to the homepage trend-signal.com and you'll see at the top of that page the book free webinar button. So you can do that. Just it's easier to do it this way than trying to send out a link, really. So trend-signal.com and then click on the book free webinar and then complete the form. And then we'll teach you all about the strategies that we provide here at Trend Signal, the systems, the tools that we provide home traders as well to help them to trade with greater confidence too. But that's pretty much it for me. If you've got any questions, fire them into the questions box. I'll hang around for another 2 or 3 minutes. But otherwise, thanks very much for joining me today. And do please tune in next Tuesday as well, where we'll be doing some more screen shares. We'll look at some live markets, no doubt, and all sorts of good stuff. All the best, everybody. Happy trading, and thanks for being here. Bye-bye for now.